All right, let's get right into it. Today, we're going to tackle a huge topic: the health of the US dollar, what that actually means for your money, and the pretty high stakes game of trying to find value in a world that feels, well, full of risk. Okay, let's dive in. When you really get down to it, this is what a US dollar is. It's not backed by gold anymore. It's an IOU. It's a promise. And that really brings up a massive question, doesn't it? What happens when the world's most important promise comes from the world's biggest debtor? And that question gets a whole lot more urgent when you see this number: $1.6 trillion. That's the US government's annual deficit. A shortfall that massive forces some, let's just say, extraordinary economic policies. And that's exactly what we're going to unpack today. So here's how we're going to break this all down. First, we're going to look at the health of that promise. Then we'll peek behind the curtain at the machine that keeps the government funded. After that, we'll get into the three big risks this creates for you, see how it's pushing people to look for deals overseas, and then wrap up with a serious warning about the dangers they might find there. Okay, so let's start right at the beginning, with the fundamentals of that promise. If the dollar is really just an IOU, then we have to look at the financial health of the one writing the check, the US government itself. And the scale here, it's just mind-boggling. That official annual deficit is $1.6 trillion, but honestly, that's just the tip of the iceberg. The real obligations, the stuff that's off balance sheet, for things like Social Security and Medicare, that's estimated to be around $100 trillion. And our national debt, compared to our economic output, it's sky high and still climbing. This is exactly why credit rating agencies like S&P looked at all this and basically said, you know what, this isn't a risk-free AAA-rated promise anymore. So how in the world does a government with a deficit that big pay its bills? Well, it turns to the Federal Reserve and a process with a very fancy, kind of confusing name: monetizing the debt. But don't worry, let's look under the hood of this money machine. Okay, here's how it works step by step. First, to get cash to cover that deficit, the Treasury issues bonds, basically more IOUs. Step 2, the Federal Reserve literally creates new money out of thin air with a few keystrokes. Then, and this is the key part, the Fed uses that new money to buy those government bonds. What does that do? It floods the financial system with cash and keeps interest rates super low. They call it quantitative easing, or QE, but let's be real, it's a high-tech way of printing money to pay the bills. And this quote, it just nails what QE really is. It is not some gentle nudge for the economy. It's the economic version of a defibrillator. You don't shock a healthy patient, right? You shock them when they've had a heart attack and you are desperate to get things going again. It's supposed to be a short-term emergency measure, and using it over and over, well, that can have some serious side effects. So what are those side effects? How does this high-level policy stuff actually affect regular people? Our investments, our savings? It really boils down to a trio of core risks. The first one is the big one. It's called systemic risk. This is the idea that when the very foundation, the government's finances, the currency itself, starts to get shaky, the whole system built on top of it is at risk. We're not talking about one company having a bad quarter. We're talking about a shock that could ripple through the entire market, hitting everything, including your 401k. The second one is purchasing risk. And this one is personal. Think about it. When the Fed creates trillions of new dollars, but the amount of actual stuff to buy in the world doesn't really change, what happens? Your money just becomes less valuable. Every single dollar you've saved buys a little bit less. That, my friends, is inflation, and it's a direct result of watering down the money supply. And you can see that basic trend right here. Over time, that purchasing risk has become a reality. The dollars you tucked away in a savings account 10 years ago, they just don't have the same oomph today. Their value is being slowly but surely eroded. And the third risk makes that last one even worse. It's interest rate risk. See, to make borrowing cheap for the government, the Fed intentionally keeps interest rates at rock-bottom levels. Now that's awesome if you're a borrower, but it's an absolute disaster for savers. The interest your bank pays you is so pathetic it doesn't come close to keeping up with inflation. So you're doing the responsible thing, saving your money, and you're actually losing buying power. So you put all this together, and it creates a really powerful reason for investors to look elsewhere. I mean, if your home currency is being devalued and you can't get any kind of real return on your savings, you're pretty much forced to look for better opportunities somewhere else. And that's exactly what's happening. This quote captures that mindset perfectly. A lot of smart investing is about finding value where other people only see doom and gloom. And that doesn't just apply to stocks, it can apply to entire countries. So, an investor looking around the globe is just going to find more opportunities. Now, you can find bargains anywhere, but this weak dollar idea specifically points people toward emerging markets. Take countries like India or Brazil. India has great demographics and a booming tech scene. Brazil is a commodities giant that tends to do well when the dollar is weak. Their bond markets and their currencies can offer much higher returns, which looks pretty attractive when you compare it to what's happening back home. But, and I cannot stress this enough, this is a huge but. Chasing those high returns abroad, especially in government bonds, can be an incredibly dangerous game. Before anyone gets the idea that foreign debt is some kind of safe haven, we need a major reality check. Look at this. This is the core difference you have to understand. With US bonds, the main risk is devaluation. You are almost certainly going to get paid back because the US can always print more dollars. The risk is that those dollars will be worth less. With a lot of foreign bonds, the number one risk is default. The government might just say, sorry, not paying, and you could lose everything. One is a risk to your buying power. The other is a risk to your entire investment. And don't think for a second this is some rare event. History is an absolute graveyard of defaulted government bonds. Czechoslovakian bonds were nearly worthless after the 1939 invasion. Cuban bonds went up in smoke after the revolution. We all saw what happened with Greece. And Argentina? They've made defaulting on their debt practically a national pastime, doing it something like 9 times in the last century. So here's the bottom line. When you buy another country's debt, you have basically no legal power if they decide not to pay. A political shakeup, a war, or just plain chaos can wipe out your investment in the blink of an eye. The high returns look tempting, for sure, but the risks are massive. As one wise investor put it, this might be a game you want to let someone else play. Which brings us right back to where we started. Every single investment, whether it's a dollar bill in your pocket or a foreign bond, is a kind of promise. The real challenge for all of us is to understand what those promises are actually worth and to see the hidden risks behind them. Because in a world this uncertain, deciding who and what to trust, that might just be the most important financial decision you ever make.